The main event begins. The resolution again, replacing the Federal Reserve with free market institutions would significantly improve the economy's money, banking, and financial systems. Arguing for the affirmative, Professor Lawrence White. Lawrence, please come to the stage. Arguing the negative, Columbia University Professor of Banking and Financial Institutions, Frederick Mishkin. Frederick, please come to the stage. Professor White, you have 17 and a half minutes maximum to make your case. Please take it away.
Okay. So the resolution is that replacing the Federal Reserve with free market institutions would significantly improve the economy's money, banking, and financial systems. Nothing requires that money be produced by governments. Money, like a loaf of bread or like a cell phone, is what economists call a private good. Its use is rival in consumption. If I'm using some money, other people can't use it at the same time, and it's excludable. The money in my bank account is not available to other people. And so there's goods that fail to meet those criteria are sort of the standard case for rationalizing government provision, because they make it difficult to charge users on a user pays basis. But money doesn't have those characteristics, so there's no prima facie reason to expect the market to fail to produce money of the kind that people want to hold. And of course, we still do have lots of private money in our economy. Commercial banks issue checking accounts, that's private money. Paper currency is still privately produced in a few places in the world. And if we delve into the past, even coins have been privately produced. And if we delve into the future, we have cryptocurrencies. So it seems to me the burden of proof ought to be on those who want to nationalize the provision of money. But I understand that the status quo is what it is. The supply of basic money is controlled by governments. And so the burden, in practical terms, is on me to make a case that the provision of money by the private sector is not only feasible, but preferable. So that's what I want to argue, that we'd be better off if we allowed free market alternatives to replace the Federal Reserve System and the panoply of bank regulations. I'm going to focus on a particular version of free market money. I'm going to focus on a gold standard with a free banking system because it has the best historical evidence. I consider a Bitcoin standard possible but less likely, because its purchasing power is more volatile, or would be more volatile even if it was the monetary standard. But if you think Bitcoin is the private sector money you support, please do vote for my side. Thank you. So in the kind of system I'm talking about, how would money behave under the influence of market forces? Too few economists even study this question. I took a look at Professor Mishkin's market-leading money and banking textbook. Doesn't discuss the topic of why we have central banks or what the alternatives are or whether the alternatives would be better. The status quo, and this is true in other textbooks as well, is taken for granted, and let's talk about how it works. But I'm kind of an oddball. I've been studying this issue for many years. I suppose that's why Gene asked me to take the affirmative side, but it's certainly why I accepted, because I think there's a pretty strong case. So I'm going to draw on historical examples that I've accumulated over the years. I'm going to talk more about money and banking than I am about finance. As a private good, money and banking have been privately and competitively produced through history in places where the state hasn't completely stamped it out. So money doesn't need a sovereign backer or issuer to have a market value. And this is contrary to a view known as the state theory of money, or sometimes as chartalism. There were no state insignias on the very earliest monies, on cowrie shells, on what anthropologists call hack silver, just pieces of silver that weren't in coin form. Silver and gold coins were privately produced before they were monopolized by the state, and even when they were produced by the state, they traded by weight, not by the insignia. People learned not to trust the insignia of the state as certifying the coin. In the 19th century, privately issued banknotes were the most popular kind of money. They were a bigger source of bank funding than deposits. So more than half of the money stock was privately issued banknotes. And as I mentioned, there have even been privately minted coins, and I'd like to talk about those because I published a paper last year in the Economic History Review, so look that up if you have access to JSTOR, about the successful record of private gold mints in the United States during the 3 gold rushes in U.S. history. Now, it's a complicated story, and there were some private mints that did a bad job. They were either incompetently run or they were run by scam artists who deliberately produced underweight coin. But the important thing is that those mints didn't survive. They didn't survive more than a few weeks. Once the word got out that a mint was producing underweight coins, nobody would bring them their gold to coin because those coins would not be easy to spend. The word was out. So the mints that succeeded and lasted were the ones producing high-quality coins and full-weight coins. And they produced significant volumes of coins, millions of dollars worth. So even that case can be handled by the private sector. Why did governments then choose to monopolize mints? Well, it goes back to ancient times. So you shouldn't expect to find a public welfare reason for it. It wasn't to improve the quality of the coins, and in fact, ancient and medieval mints notoriously debased the coins. No, it was a source of revenue. Right? Call in the coins, remint them with half as much silver in each coin, and you've made a tidy profit for the sovereign. Similar story applies to why governments monopolized the issue of paper currency, not to improve its quality, not because there was any market failure, but because there was a fiscal aspect to it, a revenue potential from it. Looking into the near future, people are talking about a central bank digital currency, and I say, well, hold on. First, make a case that the private sector can't produce digital currency efficiently, because we have Venmo. So why do we need a Fed version of Venmo? One concern people have about privately issued money, especially if the only thing they know about monetary history is the US in the early 19th century, is that there's going to be a confusing variety of monies trading at fluctuating values. But that's not actually the common experience. That was the experience in the US because we had laws against branch banking that made it impossible for banks to set up redemption agencies for their notes when they got out of the city where they were issued. They weren't allowed to branch across state lines. They couldn't set up redemption offices. There was the big exception, though, of the Suffolk system in New England, where a bank in Boston did arrange with other banks to accept their notes at par in Boston, and the system spread throughout New England. So there was an area where money did circulate, banknotes did circulate at full face value, 100 cents on the dollar, throughout the region. And that's what you find in other countries. Banks set up branch offices. There weren't any laws against them doing that. And so their money circulated at par throughout the country because it's in the interest of a bank to make sure its money circulates at par. They'll get more customers that way. And you could say the same thing is true about the private mints that survived. So in a freely evolved banking system based on this historical record, the definitive money was gold or silver coin. The unit of account was so much gold, so the dollar had a definition as so many ounces of pure silver, or later so many ounces of gold. The common money, though, was not coins. People didn't carry big bags of coins everywhere. They paid with bank-issued money. Banknotes, as I already mentioned, and merchants especially with checking accounts, all denominated in the gold dollar and all accepted widely at par. And of course, the technology for deposit transfer has advanced since the 19th century, but there's no reason we can't have phone transfers of gold-denominated money any more than fiat money, fiat-denominated money. So you see in these systems, only in the US, not only in New England, but also in Scotland and Canada and 50 more places. There's an article by Kurt Schuler which has a fairly complete list. Many issuers, all denominated in a common unit, widely accepted at par. All the banks are linked into a common clearing system, so they accept one another's liabilities, checks and banknotes, and then redeem them at the clearinghouse. And that keeps the system within check, but no central bank. Competition is generally better than monopoly, and the same is true in currency, and the same is true, I think we all take for granted, in deposit banking. If somebody said we should just have one deposit bank and it should be run by the government, you would say, well, they're going to be lousy on consumer service. But the same reasons that deposit banking should be competitive also apply to currency. And if you want a classic account of the argument, Adam Smith, book of Wealth of Nations, Book 2, Chapter 2, he makes three main points. It's better for customers to have competition for their business. They get better terms. If any one bank fails or makes some kind of money supply error, if it's only one bank out of 20, it's not of so much consequence than if it's the only bank of issue. And so that was the argument against giving the Bank of England an ever stronger monopoly in the issue of money in London. And then the third important thing about competition is that the banks check each other. The clearing system limits the danger of any large-scale overissue by presenting the bank that overissued with a big bunch of notes or checks to clear, and that means they lose reserves, and that's their signal that they've overissued. And it's a prompt signal, that's the important thing. So the quantity of money is limited to the quantity the public willingly will hold. Now, competition and the discipline of the clearinghouse still doesn't mean that no bank will ever fail. Adam Smith wrote about one spectacular failure during his day, the Ayr Bank, A-Y-R, but it's almost a play on words because it was built on very shaky foundations. But importantly, its failure didn't bring down the other major note-issuing banks because they knew not to be indebted to it. And so its failure didn't bring down the entire system. The system not only quickly recovered, but actually got stronger. So in Nassim Taleb's terminology, it wasn't a fragile banking system, it was an anti-fragile banking system. Other bankers took lessons from what the Ayr Bank had done wrong and stopped doing those kinds of things. So what you want in a banking system is anti-fragility, and what do you need for that? You need a healthy variety, not every bank doing the same thing so that they can all end up doing the wrong thing. It's one of the problems with today's regulatory system that we've fostered what you might call a monoculture of banking. All the large banks pretty much behave the same way because their regulators ask them to. So why do we have central banks? Let me quote what Alan Greenspan once told Jon Stewart, quote, "You don't need a central bank when we were on the gold standard, which was back in the 19th century, and all of the automatic things occurred because people would buy and sell gold and the market would do what the Fed does now," by which he meant the money supply would adjust to the demand for money. So the money supply is self-regulating under a gold standard. And of course, the US was on the gold standard when the Federal Reserve Act was passed. So here's Alan Greenspan saying the US got a central bank that it didn't need. And the main impetus for the Federal Reserve Act was that there were financial panics, a series of financial panics, but they weren't inherent in competition and decentralization or even in being on the gold standard. And we know that because our neighbor to the north, Canada, had free banking, more free banking than the US. It had banks issuing the currency. It had a gold standard. It had an agricultural economy like the US. It had no panics. So we need to find a difference between the US and Canada to explain the difference in the fragility of the financial system. And it's not hard to find. There were legal restrictions on US banks that Canadian banks didn't have, namely the restriction of branching that I've already mentioned. But also there was a requirement that US banks couldn't issue more currency unless they had more collateral in the form of federal debt. And this scheme was started during the Civil War to market union government debt. But it sort of outlived its usefulness and became an important constraint, so that when there was a seasonal demand for currency, the banks couldn't meet it, and that meant the banks lost reserves, and that's why there were financial panics. A lot of people at the time saw this and said, we ought to be more like Canada. We ought to deregulate our way back to stability. But the small bank lobby didn't want large banks branching into their neighborhoods, and so politically it didn't succeed. And of course, small banks blocked a lot of reform. We didn't get interstate branch banking in the US nationwide until the 1990s. So that's banking. Monetary policy, the Fed and other central banks, actually the Fed's not the worst of central banks, but the track record of monetary policy is not very good. It's pretty poor. If you compare fiat monies since 1971, that's when the Bretton Woods system ended and we got pure fiat money, we've had higher inflation than we had under the classical gold standard. We've had a less predictable price level, and you see that in the shrinkage of the market for 30 and 50-year bonds. They've become very rare because nobody knows what a dollar is going to be worth 30 years from now, whereas under the gold standard, you got a pretty good idea what the dollar is going to be worth 30 years from now. It's often thought that, okay, we've got more inflation, but at least we've conquered the business cycle. No, I got bad news for you. We haven't conquered the business cycle. In an article with two co-authors, we measured the variance of real output in the US since 1971, and it's no lower. Output is no steadier today than it was during the period of the classical gold standard. So, I think a gold standard with free banking, I think there's evidence, would be better than the status quo. It would give us more stability of purchasing power. It would give us a sounder banking system. We wouldn't need too big to fail. We wouldn't need the moral hazard that comes with that. And it would give us sounder finance if we didn't have a central bank to issue things like the Greenspan put, which sort of opened the door to moral hazard in other financial intermediaries. How can we get there? Hopefully by, not by hyperinflation, which is how some countries have lost their fiat monies. Nobody hopes for that. But by reform, and I don't think it's going to happen tomorrow. I understand that. There's a long case of education to be made. But when we're ready for it, we'll be ready for free banking on a gold standard. Thank you.
Speaking for the American Federal Commission, take it away, Frederick.
So I feel a little bit like Daniel going to the lion's den, because I know the Soho Forum is a libertarian organization. So, one thing that was said earlier is actually the need for debate is so important nowadays. We're both in universities, and my university, I don't know what George Mason is like, but there really are a lot of topics that are extremely difficult to discuss in a rational way. It's very depressing sometimes. Because of my age, I actually teach, for example, about culture and economics. None of my junior colleagues will do so because they realize it could cause them a lot of problems. And for me, if it doesn't work out, I just retire. So it's not a big deal. So what I'd like to do first, because I'd like you to think about this as part of the debate, is I'd like to actually make some general comments about libertarianism. Okay? So I have read Atlas Shrugged. I've read Fountainhead. I love the books. Fantastic books. I enjoyed them thoroughly. But let me give you a perspective on where I stand. So if we take a scale of 1 to 10, and 1 is progressives like Bernie Sanders, let's put them at that end. And 10 would be the two Pauls, Ron and Rand Paul. Milton Friedman, I put probably about maybe 8.5, 9 kind of thing. I'd be about a 7. So I am somebody who's very pro-markets. And the issue that is critical, however, is that markets only work well if they have the right governance and certain characteristics. So markets in general are better, but on the other hand, there can be problems. And there are actually 3 kind of problems that you face in markets where they don't do the job very well. One is where they may not be able to have enough competition. So you can get monopolies developing, where in fact there's no competition. And one of the things that you mentioned, which I really strongly agree with, the key to getting an economy that's successful, and actually getting life to be successful, is competition. Actually, one of the things that people don't realize about universities is that we actually are very dog-eat-dog. We are always competing with others in American universities in terms of making our place more prestigious. And that's one of the reasons why U.S. universities dominate the world in terms of people wanting to come to universities. And I actually really like that. So one is that you want a market that actually will be competitive. The secondly is that markets can have problems if, in fact, information is not there. We call this asymmetric information in economics. Different parties have different information. Things can really get screwy, screwy in that case as well. So. What you think about this is you ask yourselves, and then the third is what we call externalities. The fact that you can do something that actually harms somebody else, and actually you're not able to compensate that person for it. By the way, there can be positive externalities. We usually worry about markets when they're negative. Where positive externalities, like for example research development, is where you do something and in fact it helps everybody else and you don't get paid for it. So those 3 things mean that markets sometimes don't work very well. And the key is getting the right institutions behind markets to get them to work very well. And in fact, this is something that I teach and talk a lot about in my courses, where I actually say, if you remember, the Gordon Gekko in Wall Street said greed is good. Well, greed, in fact, generally is good if the markets are set up the right way, but greed can also be bad. And so that's, I think, a very important point. And there's a wonderful book by 2 University of Chicago economists, not exactly on the progressive side, to say the least, Luigi Zingales and Raghu Rajan. They have a wonderful title of the book. It's called Saving Capitalism from the Capitalists. And what they do is they go into what problems that mean that markets frequently in developing countries have bad institutions behind them, and things as a result don't work out very well. And there's a classic example of this, by the way, which is what happened with the end of the Soviet Union. So the Soviet Union breaks up, communism is gone, and in fact there's a push, particularly by Western powers, to say, oh, we need to privatize and use markets to make things better. Well, what happened was, yes, we privatized, yes, there were markets, but in fact what happened was that we got better and more capable monopolists taking over these markets, and it made things much, much worse. And that's actually what's going on right now. In fact, the war of Ukraine versus Russia is going to be one of the most important events in history, I think. Because this is a battle not just about territory and, whether you're Ukrainians or Russians or whatever, and aggression. This is a battle of ideas. Whether Ukraine, which has moved from being very much like the Soviet Union or like Russia, and is trying to move towards the West, and I recommend very highly to you to watch the first season of Servant of the People, which is Zelensky's show, which talks about all these, trying to change. It's very funny. And how they're trying to move from this corrupt, the military is just like the Russian military, how to move it from there to something that's much better. So let me actually now get to the issue. So I hope that stimulates some of your thinking about libertarianism, because I know where the group that I'm coming in. Luckily, when you do this, who wins the debate, I got a shot because you had to vote first and then you get to vote again. So the question is, should we replace the Fed by free markets? That's really the issue. And in fact, there are many things that I actually agree with that you've said in this context, that Larry has said in this context. He talked about competition. He also talked about the fact that money can be private. It doesn't have to be done by government. I agree completely with those issues. The real issue, as I'm going to argue, is will the economy perform better with a Fed or without a Fed? That's really the issue. And so I want to talk about that. And when you think about how you set up a system where you don't have a central bank, you have to tie money to something. So in fact, Larry talked a lot about the gold standard. I think it was good that he said, a lot of people are talking about crypto. Libertarians frequently love crypto. The best thing about crypto was the Larry David commercial during the Super Bowl. That to me was, but crypto is really not something that would be suitable. It actually is designed to be very much like gold. It has to be mined so that in fact there's something that restrains the total production of it with real factors, in this case using up a lot of electricity and servers. But clearly crypto has such wild fluctuations in value relative to other prices that if you actually tied to crypto, you'd get incredible fluctuations in the price level, which would be very, very damaging. And then, of course, there are all the issues about, is crypto really secure? Is it safe? The brokerages. I think after FTX, the crypto boom in that regard is over. So I think the issue is we really do want to talk about the gold standard, because I think that is a case of where we did have a private money type system, and it actually functioned. There's no question that it could function. So here's, I think, the good news and the bad news about a commodity standard like the gold standard, or if you do silver or whatever. What is the good news? The good news is that if you take very long horizons, and Larry mentioned 30 years, then in fact you do get a stable price level. So for example, if you look at the price level when the American Revolution occurred, and then look 100 years later, it's very similar. So you don't tend to get these big trends, which we've had in terms of actually a price level which inflated very much over time. So that's the good news. The bad news is, as John Maynard Keynes says, in the long run, we're all dead. That's not the horizon that, in fact, most people are functioning in. They're functioning on much shorter horizons. What they really care about is, what are the prices going to be next year? Even sometimes next 3 months. But what are prices going to be like in the next year? When you actually look at the data, and in fact, there's a very well-known paper by Anna Schwartz, who I don't know where we put her on the scale, but she's up there with Milton Friedman. And Anna, by the way, who's a wonderful scholar, a wonderful person. We all miss her. By the way, one of the feistiest people you've ever met. I would go to conferences with her. Somebody say something, and she would just rip them apart. She was fantastic. I loved her. And she was also a nice Jewish grandmother, too, which is, again, a plus from my perspective. But she wrote this paper and looked at actually the performance during the gold standard. And what you see is, and it's not surprising, that because gold is produced and you can have discoveries and so forth, or all of a sudden the demand for gold changes because it can be used more for certain purposes, that what you find is that, in fact, the price level had much more fluctuations under the gold standards when you take the shorter horizon. But I think that's what's relevant in terms of thinking about how the world works. The second issue is that when you look in the US, and in fact, I do think that Larry's right, that there were issues of design of the system, that you did have financial crises and financial panics that were very, very frequent. And in fact, I'm going to argue that if a Fed knows what it's doing, if the central bank knows what it's doing, it improves tremendously on that. But it sometimes doesn't know what it's doing. So the classic example of this is the Great Depression, where the Fed was a new organization. Because of internal politics, it's really fun. If we had a lot of time, I tell you about all, one of the things you learn when you manage people, if you basically tell people what to do, frequently they act like teenagers who just do the opposite. Those kind of tensions occurred in the Federal Reserve System. And as a result, when we started to get the first set of banking failures towards the end of 1930, in the fall of 1930, the Fed absolutely did not. It was like Nero fiddling while Rome burned. It was a disaster. Now, you might say, well, that can keep on happening, but we learned our lessons. In fact, there's a wonderful speech that Ben Bernanke gave. He was a governor at the time of the Federal Reserve. He was not the chair. And it was Milton Friedman's 90th birthday. And Ben gave a speech where he talked about this very famous, brilliant, fantastic work, which I recommend highly to you. It's fun. It even has a little sex, drugs, and rock and roll in it, too. But it's scholarly about what was going on during the Great Depression. But Ben said, he said, Milton, it's your 90th birthday, you're a great man. He said, about the Fed, you were absolutely right. They screwed up. But we've learned how not to do that again, and it's not going to happen. And then we had Ben Bernanke, who was the chair of the Fed. And of course, I was there with him as a governor. And as a result, we did not have a disaster with the global financial crisis. So I'd like you to think about what might happen or what the world might look like if we didn't have a central bank to basically do lender of last resort operations. They did it, by the way, in 1987 under Greenspan. Very, very important. It's not a well-known example, but in fact, there was a potential for everything to fall apart when the stock market fell by 20% in one day. That the Fed then actually took steps, very controversial. There were a lot of mistakes made, by the way. The Fed took 16 months really to get the plan implemented properly. When I was a governor, I was actually at one point wanted to dissent because I felt that we were not doing our job properly, that we were getting behind the curve. But nonetheless, the Fed was able to stop a depression from occurring. And we got close, closer than people realize. It was the scariest time that I've ever experienced as an economist. But let's look at, but in that case, you might say, well, this is because of all the incentives from regulation, the moral hazard that Larry mentioned. That's why this happened. But let's take a look at COVID. So the COVID pandemic is really a classic act of God, okay? That anybody says you can predict it. Yeah, we might do the pandemics. I just finished watching this terrible series that I really loved called The Last Ship. It was done in like 2010 or something like that, and it's all about a world pandemic. We've talked about that. But really, this was a pure act of God. And in fact, if you look at understand financial crises, and let me tout my own work, I've done a lot of work on financial crisis. My textbook talks about this a lot. There's a way of understanding the dynamics of financial crises. You look at what happened with the COVID pandemic, and it looked like, boy, could have it sent us into a financial crisis and a depression. It actually had much less impact than the GFC, or the global financial crisis. In fact, the reason was, and we got very lucky, because if COVID had happened before the global financial crisis, I think we would have had a disaster. Because what happened during the COVID pandemic was that within 2 weeks of announcing the pandemic, and that was pretty quick. It wasn't just that we thought about it. I remember I was ready to go on a trip and didn't think anything of it, and then 5 days later, the WHO declared a pandemic. That the Fed basically did in 2 weeks what it took them 16 months to do. And that's because there was learning by doing. They learned how to handle it. In fact, I'm even going to give credit to our politicians, because I don't want to start talking about this. My head will start to blow off. The partisanship is so awful right now, but in a partisan world, they actually passed legislation to pump a lot of money into the economy when it was needed. It was extraordinary that it was done as fast as it was, even though they still all hate each other's guts. So it was really an extraordinary period that thinking about what the world would have been like if, in fact, we didn't have a Federal Reserve when the COVID pandemic hit is just absolutely incredibly scary. So let me conclude by saying that the bottom line is, I think that one of the worst ideas, now I'm not thinking that libertarianism in general, because I think there are a lot of points about libertarianism that you can see that I think are appropriate. And the reason why I think that people are attracted to libertarianism is that people who think that the government should do everything, progressives, I have a colleague, Joe Stiglitz. He did this wonderful research on why markets fail. He never, ever worries about the fact that governments fail. And that's really important. And that's why I end up being pretty pro-market, because even if there's a market failure, you have to ask yourself, if we put in this regulation, is it going to make it better? And sometimes it doesn't. And we've all had to deal with this kind of issues of crazy regulation. Actually was the Commodore of a boat club that a barge came down from the Mario Cuomo Bridge, destroyed our pier, and we can't rebuild it because we have, well, finally we might, because we had a nightmare bureaucrat who, from the New York Department of Environmental Conservation, who reminded me of the bureaucrat in Ghostbusters, the first one. Remember that bureaucrat? Lets all the ghosts out. So we really have to take that balance, and I think that's why we need to debate these issues. But to be very frank, I think the idea that we would want to abolish central banks and to replace them with something like a gold standard and free markets, I have to tell you, I think it's one of the worst ideas possible. It would be a scary world. Thank God, my view is that that's not going to happen.
Seven and a half minutes for rebuttal. Take it away, Larry.
Thank you for those remarks. Professor Mishkin's main argument against the resolution is that we need a central bank, we need the Federal Reserve to ensure economic and financial stability. And let me reemphasize something I said earlier. In the study I did with George Selgin and Bill Lestraps, it was in the Journal of Macroeconomics in 2012, we found that real stability in the economy hasn't been any greater under the Federal Reserve, even if we confine ourselves to post-1971. True, they screwed up in the Great Depression, and so if you add that in, then the Fed's track record is even worse than the classical gold standard in terms of output stability. But even if you say, we're not going to count that, it was just practice. The Fed was still learning. Even if you just take a more recent period, their track record at stabilizing output is not greater. Okay, well, let's focus on financial stability in particular. It's often thought that the Fed is necessary to supervise and regulate banks and to serve as a banker's bank. But those were all functions that were performed by commercial bank clearinghouse associations. And they had better incentives to get the regulations right. That is, banks that were member of the clearinghouse wanted assurance that the other banks whose liabilities they were accepting were not going to default at the end of the day. So they wanted the other banks to be solvent, and they wanted some assurance that they were solvent. So clearinghouses demanded minimum capital, they demanded to see the balance sheet, and they actually demanded to audit the balance sheets of their member banks. So an appropriate amount of that kind of regulation is undertaken in the private sector. The clearinghouses, of course, wouldn't impose regulations that were against the interests of the banks or against the interests of consumers, unless they could organize a cartel, but there's no evidence that they were successful in doing that. It's often thought that the Fed is needed to backstop the financial system in the event of bad happenings, panics, natural disasters, pandemics, that without somebody there to make the printing press go burr, that there's going to be a lack of confidence that everybody can get their money when they want it. But in practice, a banking system without a central bank actually provides better incentives for banks to act with more restraint, to act with more prudence. That's an absence of moral hazard. I referred to the moral hazard problem earlier. And it's not just from too big to fail, it's from encouraging banks not to be adequately liquid. Probably the biggest piece of evidence I can offer in this regard is that the Canadian banking system, which had no central bank, which had no deposit insurance, weathered the Great Depression without a single bank failure. The economy went down, sure. I mean, the economy suffered because the U.S. is their biggest trading partner, so they could hardly have not had a depression in output, but they had no financial trouble. They didn't have any bank failures. Or we can compare the Scottish banking system during the heyday of the free banking period to what was happening in England, where the Bank of England was, well, people were encouraging it to act as a lender of last resort. I guess I should admit they didn't actually do very much last resort lending. But in a competitive system, if one bank overexpands, the other banks will discipline it by draining it of reserves. And that helps ensure stability of each bank, stability of the banking system, and actually stability of overall spending in the economy. The problem with a lender of last resort, again, is a moral hazard problem. In a sense, it underprices the assurance that it's giving, and thereby creates an incentive in banks to take on bigger risks than they would if they were bearing all the costs themselves. Let me finish with since I quoted Alan Greenspan earlier, with a quote from Paul Volcker. So after he had served as chairman of the Fed, Paul Volcker was invited back to the Federal Reserve of Kansas City's annual conference in Jackson Hole, Wyoming. Jackson Hole, Wyoming is a pretty expensive place. I wonder how they afford it. But here's what Volcker said, quote, this was on a panel on the role of the central bank. He says, quote, "If you say a central bank is essential to a market economy, I have to ask you about Hong Kong, which has no central bank at all and is the absolute epitome of a free market economy. Yet it does quite well in terms of economic growth and stability." And I think Hong Kong is not an outlier here. If you look more broadly at the history of banking systems, you'll find that the ones that were least restricted exhibit greater stability, because on net, bank regulation has been more of a source of instability than of stability. Thank you.
7 minutes of rebuttal from Professor Mishkin. Take it away.
So let me talk about several issues here. So first of all, let's talk about this issue about how well the Fed has done since 1971. And I think it's clear that the great inflation was also a very, very bad period of monetary policy. So here's something I'm actually going to be patting myself on the back and academia on the back on this. One of the issues is whether the technology of central banking can get better or not. And indeed, there was a huge change in terms of research in macroeconomics. It's called the rational expectations revolution. Bob Lucas, one of the really important players in this regard, at the University of Chicago. And one of the things that we learned is we learned the importance of credibility and the nominal anchor. So that you actually have to have a nominal anchor. And you could use the gold as a nominal anchor, by the way. That's a possibility. But in fact, what people started to understand was that, in fact, if you have a strong nominal anchor, something like an inflation target, that you can actually get much, much better performance. And in fact, that was exactly what eventually was adopted. It took a long time. There was shades of it. There was inflation targeting light. When I was at the Federal Reserve Board, I was pushing for this quite hard internally, but couldn't talk about it till I was ready to leave. And I left in 2008, and then it only took another 4 years before the Fed implemented it, even though it was really pretty obvious that they had to go in that direction. And in that sense, we've actually had much better monetary policy. Indeed, we talk about this period in economics, the profession talks about it as the Great Moderation. It was interfered with by the global financial crisis, and that's a separate issue of these tremendous shocks that really have non-monetary elements, but can create huge problems. So one of the questions is, yes, the Fed did make mistakes in the past, but on the other hand, science has helped. There's something called the science of monetary policy. It's a little arrogant because there's no such thing as economic science like there is in biology, or there is in something like physics or whatever. But we've really come a long way, and I think that's really very important in terms of thinking about this. The other issue is to talk about these issues of regulation, which I think are very important. And I do agree with Larry that the clearinghouse associations actually did have better incentives frequently than government. And that's one of the reasons we actually like markets, because we think frequently that the pursuit of private profits or whatever can actually produce more efficiency and better incentives. And I think actually he's right that I should tell you that all my years spending at the Fed, I spent 5 years in FOMC meetings, 3 when I was an executive vice president of the Federal Reserve Bank in New York, and then 2 when I got to actually sit at the table when I was a governor. Although I never ever felt that politics influenced a monetary policy, I can't say that about regulation. And so the government, and it's sort of obvious why, because monetary policy affects everybody very broadly. Regulation affects particular institutions, and boy, do they lobby like crazy. And it's amazing what some of these guys can get away with. I'm still mad at Kristen Sinema because the carried interest is an abomination. It's outrage. If you don't know what this is, it's basically that you allow private equity firms to charge fees and then declare that they're capital gains and pay half the taxes. This is just, and yet she blocked it single-handedly. Well, I don't know if this is true, but somebody lobbied her, gave a few shekels here. Something happened. So, so we know that this can be an issue. There's one really huge problem. So I would actually agree with Larry that I think actually that clearinghouses, because the banks themselves, they do regulate, by the way. There's a lot of regulation in the clearinghouse associations that was done. Not now because they don't have to do it, but they did a lot of regulation. Their incentives were better. The big problem is that they can't create money out of liquidity out of thin air. They don't have this ability to do the lender of last resort. That's the real issue. So I don't agree with him on the, I don't disagree with him on the view of incentives, but the bottom line is that they just don't have the machinery to solve a problem when a big enough shock hits. Small shocks, by the way, they do a fairly good job. The big shocks are what we're really worried about. And by the way, that's why the Federal Reserve was created. Because remember that there was a banking panic in 1907, that's one of the huge panics, and we had a depression as a result. They had a National Banking Commission. The person who helped bail out the system was J.P. Morgan. He had $1 zillion, but he didn't have the multi-zillion dollars he needed to create basically infinite liquidity. And so that's the problem that I have. The last thing I want to say is, referring to the Hong Kong Monetary Authority, he's absolutely right that Hong Kong does not have a monetary authority doesn't do monetary policy. All it does is it does do some regulatory stuff, that they do not have a central bank of the type that other countries have. The reason they can do that is they're a small entity. They basically tie their currency, the Hong Kong, whatever it's called, Hong Kong dollar, yeah, that's why I'm having trouble. The Hong Kong dollar to the US dollar. And that would be great. If you're a small country, you do not need to have a central bank, and you could have arguments why you might not need to have a central bank. So I have no problem with that. The problem is that we are the big gorilla in the room. In fact, whatever the US does affects everybody else in the world. We're seeing it right now. The Fed, by the way, made some very serious mistakes. I don't know if you... I'm on CNBC every time there's an FOMC meeting. Since April of 2021, I've been saying the Fed has a flawed policy framework. They're going to get in trouble. I then had an op-ed in the Financial Times saying that they really have their head up their tuchus, to be a little bit of a New York term. But I will say the following. It's not been a disaster. It didn't lead to disaster. It led to a very difficult situation. What the Fed has done, though, is they actually got it in terms of understanding that they had to commit to keep inflation stable and inflation target. And they turned the super, usually they're very slow to turn the super tank around. Now it was a powerboat. So again, I think this is, again, some of the learning because of the literature, which, you know, as I say, I have been a contributor to it on rational expectations and how to think about monetary policy, that the technology actually has worked. Are we going to suffer a little bit because the Fed screwed up? Absolutely, but not all that much. That doesn't mean we're going to have a recession. Some bad things, but I'm talking not that bad. So in conclusion, I just have to strongly disagree with Larry on this.
Thanks to you both. We now come to the Q&A portion of the evening. There is a microphone over there, so line up and ask your questions. And up at the balcony, I'll recognize people who want to ask questions up there as well. In terms of the Q&A, you both have the option of asking each other a question at any time. You can waive that, see what questions there are from the audience. Either of you want to ask each other a question at this moment? Looks like not. I want to take moderator's prerogative to ask Professor Mishkin a question, sort of the inevitable thing your remarks would provoke. Two parts, really, that relate to each other. To what extent do you think that the Fed causes instability, causes business cycles, and in a related way, to what extent do you feel that the Great Recession of 08 and 09, which brought an end to the Great Moderation, after all this wonderful knowledge the Fed is learning, we got the worst downturn since the Great Depression, and then which Ben Bernanke did not anticipate, and which Anna Schwartz didn't either. And to what extent was that caused by the Fed? And to what extent does it mean that we should lose confidence in all this learning the Fed acquires? And then most recently, the inflation that's occurred where we don't know where that's going, which the Fed also seemed to deny was a problem until, of course, about a year ago. So could you address those challenges?
Yeah, so and there's been a whole lot of debate about this issue about.
Into the mic, please. Yeah, go ahead. Yeah. Is it working? Yeah, you're okay. Go ahead. Yes.
Okay. So there's been a lot of debate about this. In fact, John Taylor, a very well-known economist at Stanford.
Go ahead. Yes, please. Go ahead.
Okay, sorry about that.
Yeah.
I'm not used to that. I wish
No.
I could lavalier because this one.
Okay.
Not just sing. I'm gonna give you a little tune. Here,
You're pivoting here. You pivot a lot. Go ahead. Just keep. You're a great performer, but keep the mic up with the pivot.
Okay.
Your place.
Doobie-doobie-doo. No. Okay. So there was a big debate actually where John Taylor basically accused the Fed, said the Fed helped create the housing bubble by the extremely easy monetary policy. So I've been a student of financial crises. In fact, the reason I became an economist, and particularly a macroeconomist, is because my father, who fought in World War II, didn't talk about it a lot, always told me stories about the Great Depression and how terrible it was. And so I became an economist because I really wanted to understand how to prevent depressions. And in fact, the research that started, actually, when Ben Bernanke won a Nobel Prize for this research, that was the famous 1983 paper, which is why he won the Nobel Prize, actually pointed out that, that it was an asymmetric information problem. So this literature that actually developed in the 1970s, understanding the problems of having different parties not having the same information, how in fact, this actually was the primary cause of the Great Depression. And in fact, I'm going to plug my textbook. If you read my textbook, there's a whole chapter on financial crises and talks about what generates financial crises. And when you look at it, the issue of Fed monetary policy would be very easy before the global financial crisis. That's not the main story of financial crises. You can actually go through it, understand why they develop and so forth. Regulation actually is much more important, lax regulation. But that monetary policy actually can add a little fuel to the fire, but is a minor part of the picture. And so when you actually study financial crises, understand why they develop and so forth. And financial crises, by the way, are part of sometimes something that's good that's happening, which is that you get financial innovation. And the financial innovation, unfortunately, they don't quite get it right. So this is the invention of the modern corporation, extremely important in terms of economic growth. We had the South Sea bubble. The financial innovation is not quite gotten right, and then it blows up on you. And so that's really the story behind what happened during the global financial crisis. When we talk about the recent episode, where I've been very critical of the Fed, there's a question of degree. Did they screw up? Yeah, they really screwed up. They had an extremely flawed policy framework. If somebody wants to ask questions, I can go into exactly how they just really had a bad policy framework, which deviated from what we had learned before. And then also some bad forecasting, and then a little bit of bad luck. So it was all combination. Ukraine is not the Fed's fault. However, they have turned it around. Now, do I think this has been costly? Absolutely. Are we going to have a recession? I think it's extremely likely. And we can talk about why. I think the idea that we're going to get a soft landing is, you know, if you get super lucky, maybe, but boy, you got to be really lucky. So I don't think that's going to happen. But in the end, this is not going to be a disaster. So yes, are we going to have a period where inflation is too high? Absolutely. It's coming down. Is the Fed going to have very tight monetary policy, which is going to hurt the economy? Absolutely. But this is not a disaster. And in fact, when shocks hit the economy, business cycles are going to be around. So at one point, people saying, oh, great moderation, we're never going to have business cycles again. No, it's like death and taxes. It's always going to be around.
Okay. Would you like to comment on the question, Larry, about the Great Recession and the recent inflation? Yeah.
Yeah, so I agree every time you said the Fed screwed up. I agree with all that. The question is, can we rely on central banks to continuously improve over time? And I don't see a lot of evidence that we can. So, as Gene said, the Great Moderation came to an end, and you mentioned John Taylor, and Taylor has pointed out that compared to what it had been doing during the Great Moderation, the Fed started after the dot-com bubble. The Fed kept interest rates too low for too long and thereby fueled, maybe not the only cause, but fueled the housing bubble. And then more recently, we've had 9% inflation, which shocked even me.
Shocked me too.
I thought when it got to 5%, they would put their foot on the brakes, but it took a little longer than that before they really started to take it seriously. So some of the things I thought the Fed had learned, they don't seem to have learned in a very robust way. And central banking policy is subject to not just continuous improvement in technology, but fads and fashions, and sound ideas go out of style, so it's not a reliable system.
So I agree with you that the issue that assuming that the central bank is always going to get it right is incorrect. And we see they make mistakes, they get groupthink. This was actually, I talked to Jay about this kind of stuff. They just had a groupthink that occurred, which was hugely problematic. And the mistake, they had this team transitory stuff, that all these shocks were to be transitory. There were a lot of people in the markets who thought that too. I thought that the problem is that they didn't talk about the demand shock, which was huge because of what I consider a very bad piece of legislation, which is the American Recovery Act. It was just way too large and was not a Recovery Act at all. It was at least double what was needed in that context.
Nor is the Inflation Reduction Act.
Oh, the Inflation Reduction, yeah. Well, let's not even call it the Inflation Reduction Act because it has nothing to do with inflation reduction. Okay, so it's, So let me make a dig that it's like modern monetary theory, and when I was a kid, I'm old, but there was a joke that you may remember, which was the Holy Roman Empire. It wasn't holy, it wasn't Roman, it wasn't an empire. And modern monetary theory isn't modern, it's not monetary, and it's not a theory. so
you guys are starting to agree with each other too much. We're losing the debate here. We're losing the edge of.
I think that the issue here is the question is when you make a mistake, you're not going to get it perfect. It's a tough business doing forecasting, by the way. I've been in there. The issue is going to be what the alternative is, and as I've argued that these alternatives of tying to something that has some real aspects to it, like gold or crypto, whatever, is not going to produce the kind of stability that people like. People think of golden age. There were some very good things about the gold standard, by the way, in terms of promoting globalization. But that's a whole topic that we don't want to discuss because that's not the subject of the debate.
Okay. Question. Please ask a question as a question. Go ahead. Yes.
It's a question for Larry. Just wondering what's special about tying a free banking system to the gold standard as opposed to two metals like gold and silver, or for that matter, just having a free banking system based on multiple competing fiat currencies?
It's a good question. I've studied bimetallism, and there's a better case for bimetallism that Milton Friedman discusses that is better than the case that William Jennings Bryan made for it. But still, the problem that bimetallism tried to solve was have both gold and silver full-bodied coins in circulation simultaneously. But it's a rearguard action. You don't need to do that once you have bank-issued money. You can have all the small change you want in the form of bank IOUs, bank notes, and token coins. You don't need to have full-bodied coins. Now, if you can trust the bankers. So people didn't trust the government. They wanted government coins to be full-bodied silver, and I understand that. But if you can trust the issuer of the tokens, you don't need two metals. Now, on the general point is quite right. There's nothing unique about gold except for its history. All right? So I use gold as an example because we have some evidence on its behavior. But a silver standard would behave pretty much the same way. Other commodities, I don't know. But one of the nice things about a gold or silver standard is that it has this self-correcting tendency built into it that if there's an increase in the demand for money and it starts to raise the purchasing power of money, it'll stimulate more supply. Gold miners will dig a little deeper, more prospectors will go out, there'll be more research and development on how to produce high-grade gold out of low-grade ore, that sort of thing. So it is a long-run tendency, I grant that. It's not a year-to-year thing. But actually, some of the views economic historians have had about how much volatility there was in the purchasing power of gold from year to year are based on faulty statistics, where in the 19th century, the price indexes are reconstructed from just a few commodity series that we have. They're not as broad-based. If you correct for that, it doesn't look so volatile. It's because we've only got an index with, a dozen or 2 dozen commodities. But in principle, it could be something else if everybody converged on something else. We know historically they converged on silver and gold. I think it's plausible that the economy would again, given this long-run stabilization property that's built into them.
Comment from you, Frederick, or you want to pass? Comment? No?
I have an interesting question.
Mike, yeah.
Interesting question, not a debate. I always thought there was an issue, though, that could be a problem if you have bimetallic, that if there's a big supply change in one versus the other, that it does create problems. And
That's right.
So that's why I actually agree that if you're going to do it, probably it's a little bit better to pick one commodity just because of this issue. I don't know if you agree with that. It's
No,
not
I
really
agree
a
with
debate,
that.
but I
So-
think it's interesting.
We've got agreement. Okay, next question. Question.
Yes.
Into the mic, please. Yes.
My question is for both of you. Can each of you in layman's terms define inflation versus deflation as simply as possible, please?
Frederick, why don't you take it?
So this is what I do in my textbook, so hopefully I'm going to get it right. So inflation is an increase in the price level. What do we mean by the price level? It's the average level of prices. And now there's a little tricky issues whether you use the CPI, the PC deflator, because there's different weights on different goods. So inflation is when the average level of prices is going up, and deflation is when the average level of prices is going down.
Comment, Larry?
Yeah, I'm not sure whether this motivates your question, but 100 years ago, it was different. The term inflation was used to describe what today we call monetary expansion. That is an increase in the supply of money rather than the result, which is the rising price level. But I've given up that debate. I mean, what's the point? We have a perfectly good term for monetary expansion. It's monetary expansion.
Next question, please.
agreed again.
I'm afraid. Excuse me, I'm sorry. Only one question at a time. Only.
I didn't address deflation.
What?
No,
Deflation.
deflation is just a decrease. So the average prices are all going down. That's a deflation.
Yes, okay. Next question.
Crypto is kind of dismissed, but it still has more than $1 trillion market cap. The price of Bitcoin is actually higher now than it was before FTX, and it's probably going to mature over time and have more stable pricing. Isn't it likely that that's actually a better currency than gold as a private currency?
Question for Larry. Go ahead, Larry.
Yeah, this reminds me, gives me a chance to plug my forthcoming book, which is coming out in April, entitled Better Money, Gold, Fiat, or Bitcoin, ? And there I address this question. If you look at the supply curve for Bitcoin, it's vertical. And that means shifts in demand are going to be fully reflected in the price. There's no response in the quantity. That's the big virtue that a gold standard has over a Bitcoin standard. And so it seems to me that people would gravitate toward a gold standard for that reason. Now, I might be wrong. If the public embraces a Bitcoin standard, great. But there's no built-in tendency. As Bitcoin's market cap grew, you didn't see any decrease in the volatility of its purchasing power. And as its market cap fell, you didn't see an increase. So there's no correlation between those two things.
Would you favor flexible crypto? You could make not Bitcoin, but a crypto flexible?
What do you mean by that?
There are projects underway, and in fact, I'm consulting with one of them
Oh, wow, making money from that.
to
yeah.
provide to provide a cryptocurrency with a more elastic supply.
Oh, wow, okay.
But of course, it all has to be formulaic. There's no discretion here. So we have to write down a formula for how the money supply should respond to changes in the purchasing power.
Going to be called the Larrys. Nice.
So we're actually in agreement.
The
I know.
project is
What's your
called
comment, Frederick?
Versaga, if I
Right.
may please.
What's it
So we're actually in agreement here. I think the issue is that crypto has incredible volatility. And there also are some security issues, too, about crypto as well. You know, I have a box in my textbook that said, is Bitcoin money? And the answer is money has three characteristics that are extremely, that define what we mean by money. One has to be unit of account, okay? It has to be a unit of account, it has to be a transaction medium, and a store of value. Now, crypto actually may be a better transaction medium because of this blockchain technology. That you don't have to wait to get the money, it's instantaneous. So blockchain technology has some real pluses to it. But on the other hand, it just has this incredible volatility, which means it's not a good unit of account because it means prices will be bopping around like crazy every day. Think about going to the supermarket, and you know you may not have a inflation rate over the 100 years, but every day there's a 10% difference in the price of oranges. You get to be pretty crazy in that kind of world. And as a result of its being very volatile, much more volatile than other assets like stocks and bonds, it actually has problems as a store of value. So I think that some of the technology from crypto is going to be very valuable. And that's going to be the transaction medium part of it. But I do think that as it's designed now, it's not a viable option.
Yeah, thanks. We have a question from the balcony, so please state your question from the balcony. Go ahead. Take it away. Oh, you need the mic. Go ahead, yes.
Yeah, so I agree with Professor Fred that we do need a lender of last resort, but we didn't talk tonight about the politics of the Fed. And I don't think it's a coincidence that they kept the easy money policy up until Powell got renominated and only then started tightening, because Powell wanted to get renominated, and he knew in order to do that he had to placate the Democrats, and their party line was we have to keep throwing money in, and then he had to placate Maxine Waters that, yes, the Fed's job is to create diversity, equity, and inclusion, and to fight climate change, blah, blah, blah. And only after that entire process
We got
did
your
they then
question.
get down to the business of starting, of raising rates.
Isn't the Fed too ruled by politics? I think is the question.
Yeah, so
Yes.
look, I've spent a lot of time at the Federal Reserve. As I said, I spent 3 years in the 1990s being sitting in the back of the room in the FOMC meetings. I spent another 2 years where I was at the table. I've been involved in terms of the Federal Reserve Bank in New York, where I was involved with the research department. And I can tell you that I never, ever felt that politics was what was driving monetary policy concerns. And I'll tell you that there's a small p politics where it is. Jay Powell is actually brilliant at getting the Congress people to understand that attacking the Fed was not a great thing to do, and particularly putting crazies on the Federal Reserve Board was not a great thing to do, because Donald Trump has, you know, the Republican Party, a lot of people are enthralled by Donald Trump and will support his views that the election was fraudulent. On the other hand, those same Republicans weren't willing to actually put in the crazy people that he wanted to put in as governors. So in that sense, the Fed can be political. I think that Jay did a very good job in that regard. But people always say this, oh, the Fed's doing this because of politics. But if you actually look at this and look at the history of the Fed, certainly in the last 20 years or so, there's absolutely no evidence that that's true. So as I say, there are issues in regulation that I do worry about a little bit on that. And in fact, I have not been happy with the fact that the Fed has talked about climate change and so forth, or inequality as issues for the central bank to be involved in, because it absolutely should not be involved in those issues, even if you think they're very important to solve. So, you know, I do think that climate change is a big issue, but it's not something a central bank should deal with. It's a question of what governments should deal with and whether they'll deal with it in an appropriate way, which again is a real problem, because even if there's an extreme externality, which there is, the governments don't always do the right thing, so it's complicated.
A comment from you on that question, Larry? No comment? Okay. A question? Yeah.
Hi. So I was trying to figure out how to turn this into a question. I'll do my best. I apologize if it's a little foggy. But one of several things that I'm trying to deal with is, you know, the whole question of gold and what's so special about that. You just said, Larry, what's special? There's nothing necessarily special about gold. In my opinion, I think that money is basically a way to get your stuff, your goods and services, and money and gold is a pretty poor approximation of the global economy. The only thing is it's hard to find, et cetera, And so what I'm trying to find in this debate is what is the alternative? I'm not sure, with gold you have alchemy, you have people who are trying to create gold out of thin air. If they were successful in that, it would destroy gold as well. So it just happened, and we've never figured that out in an efficient manner. So what is the alternative? Because I don't think it's gold necessarily, which has been tried many times. I'm not, Bitcoin and crypto, it's still in its early phases. Maybe an elastic crypto, maybe that could work because then it can flex with the economy, with global growth and global supply of goods and services. But I have yet to actually hear like a solid explanation of what would replace it.
Perhaps talk more about your elastic crypto, Larry, but take the question in any case.
Yeah, so the great virtue of the gold standard was, one, that it was apolitical, right? The quantity of money did not depend on a committee meeting and deciding, based on their reading of the economic numbers, what it should be. And it responded in a way that stabilized its purchasing power, and which has great benefits, even if it's not, from day to day. It's nice to have 30-year bonds, 50-year bonds, even 100-year bonds were issued under the gold standard. Nobody issues them under a fiat standard. There's just too much unpredictability. And there is more smoothness in the inflation rate from year to year under a fiat standard, but there's less predictability of the price level because there's no mean reversion. Whereas in a gold standard, if you see the price level falling, you can be pretty sure that it's coming back up. And if you see it rising, you can be pretty sure it's coming back down sooner or later. And fiat standards don't have that property. That's more of a random walk if you go out 5, 10, 20 years. That is, in the paper I mentioned that I did with Selgin and Lestrapes ran these forecasts. If you knew what you knew up until the day you were making the forecast of what the price level was going to be 10 years out, how wrong would you be? You're a lot wronger under fiat standards than you were under the gold standard. And at 30 years, the difference is really big.
Yes, but not under a shorter horizon. I think that's really part of the debate.
Break even is like 5 years.
Oh, that's a long time.
Okay. Next question.
All right, this question is primarily for Larry, but it can definitely be for both of you. I'm curious to hear what both of you have to say. Larry, I agreed with 90% of what you said, so of course I have to focus on the other 10%. I tend to be skeptical of the Fed in all situations except for probably World War II, where the United States came out of World War II so decisively, in part because the Fed was so aggressive with war bonds and interest rates and things like that. So prosperous, as a matter of fact, that not only were we better after the fact than we were before, arguably, but we could also defibrillate Japan's economy as well at the same time. I don't see how free banks could do better in that scenario, so I'm curious to hear if you think they would, or if World War II is an exceptional circumstance where the Fed would be uniquely suited to do well. Yeah, what's your thoughts on this?
Well, to fight wars, governments need to borrow money. They can borrow money from a competitive banking system as well as from a central bank. That's the short answer. So the Fed was actually very passive during the Second World War. They bought all the bonds the Treasury wanted to sell them. In fact, they pegged the yield on Treasury bonds. I haven't really thought about the counterfactual of what if there wasn't a central bank and there was a competitive market for Treasury bonds, but I don't have any reason to think that it would have been some kind of disaster.
And I want to agree that monetary policy was not what helped us win World War II. The Fed basically stopped doing monetary policy. In fact, it pegged interest rates effectively at zero for a very long period of time. And then, of course, that actually led to a problem where, after the war was over, where there was going to be inflation. And there then had to be a fight between Treasury and the Fed, and something called the Fed-Treasury Accord in March of 1951 is a very important event in monetary history. So I don't think that's the problem. In this case, don't give too much credit to the Fed.
Okay, sounds good.
Yeah. A question in the balcony. Take it away.
Hi. Yeah, this question is more for Mr. White. Also, I initially voted undecided, so not trying to go after you here. But the question is, how would the gold standard system be able to address the large economic shocks that Mr. Mishkin referred to, or historically, maybe what were some examples where they were able to address them in the past?
Well, the the clearinghouse associations were able to address extraordinary liquidity needs. Normally, clearinghouse associations ran on a 100% reserve basis, but if there was a kind of common shock where all the bank's customers were demanding more currency, they could issue more currency. As long as people were going to hold the banknotes and not redeem them, then everything was fine. If people were demanding gold, then the Clearinghouse Association had to get involved, and they would stretch the existing reserves by lending new reserves into existence. So they switched from a 100% reserve institution to a fractional reserve institution. And then when the crisis was over, the banks that had borrowed reserves had to pay them back, and the system worked pretty well. There was only one case ever that my former colleague, Richard Timberlake, has studied this, so look up his work if you want to read more about it. Now, in terms of other kinds of shocks like pandemics, those are not really problems for monetary policy. Those are real shocks to the economy, so they're going to have a negative impact regardless of the course of monetary policy. You can't wish them away by printing money if there's a big shock to the supply of labor, let's say. So, as I said before, the period of the classical gold standard was one of pretty moderate variation in real output. In the US, didn't have a good banking system at the time, so it's actually kind of surprising how moderate the variations in real output were, because we did have those financial panics. Other countries, by having less restricted banking systems like Canada, had milder milder recessions and less variability of output than even the US. So that's how I would answer the question. There wasn't any kind of sort of global crisis until, of course, World War I. And World War I, they suspended the gold standard. So you can't really say the gold standard failed to handle or failed to finance World War I. It wasn't tried and found wanting. It wasn't tried. It was eliminated.
So here we really do disagree. It's true for small shocks, it's not a big deal. But when shocks are big enough, then in fact, the 1873, is it 1873? I think so. 73, 79 was a very serious depression. The 1907 episode, that's when you really need a lender of last resort. That's when the clearinghouse in effect get overwhelmed. They just can't produce enough liquidity. They're actually good at producing liquidity for small shocks, and we agree on that. The second issue I think that I really strongly disagree with you on, which is I think a lack of understanding of what happens in financial crises, which is, yes, it's true that COVID was a real shock. And if that's all that happened, it wouldn't have been a very big deal. The problem was that the spillovers to the financial system, if you look at what happened when COVID first started to happen, the system was seizing up again. And in fact, the shock was actually, I think, worse in many ways than the shocks, the housing shock that caused the global financial crisis. So it's exactly this issue that when your real shock then gets into this financial system, destroys the financial system, and in fact what happens then is that you no longer have the capability of moving funds from people with excess funds to people with good profit opportunities. That's death. And that's what happened in the Great Depression. That's what could have happened in the GFC, and also very much could have happened during the COVID pandemic. And thank God we had somebody around who could prevent that from happening.
I'm afraid we've exhausted the time for the questions. I want to again say that there is an after party. Both of our debaters have consented to come to the party. You'll see they are both very approachable, so you can ask your question of them then. But we now have to go to the summation portion of the evening. And Larry White, you're up for 5 minutes to give your summation.
So I'm not sure what I can add to what I've already said. What we rely on a monetary system to do is to allow us to gather savings, a banking system, gather savings, intermediate into lending, and we want a system in which the banks are robust to monetary shocks and to real shocks, and a system where there's free competition and no lender of last resort is one where banks are going to have to operate on their own resources, or resources they can convince other banks to provide to them, and to do that they have to actually be solvent. And so the usual complaint about banking under a system without a central bank, without a lender of last resort, was that bankers were too conservative. They wouldn't lend you money unless you didn't need it, unless you could prove that you didn't need it. That's an exaggeration, of course, but we do want banks to be prudent. We don't want banks to feel that, okay, if I make this mistake but all the other banks make it too, then I'm going to be bailed out. So a system based on competition, and I keep reiterating the evidence we have from the period before the First World War, is that this worked quite well. If we just look at the United States, it worked even better if we look at systems that were less restricted in what the banks could do, is quite robust, does finance real economic growth, and does so in a non-inflationary way. So by switching to a system run by the Federal Reserve, we've gotten higher inflation. We haven't gotten any greater financial stability. We've gotten a more fragile financial system from the evidence we've seen recently. And so somehow we have to turn that ship around and introduce more competition and more fear of failure into the financial system. And that way we can have, I think, the best combination of freedom and innovation, responsibility and innovation, maybe I should say. So I'm not promising a world in which banks don't fail, but one in which failures are not contagious. Banks will have kept themselves separate from getting involved in the problems of other banks. And so the system is decentralized, and the failure of any one institution is not a big deal. Whereas when the Fed makes a mistake nowadays, it's a doozy, and it carries along the entire monetary and financial system with it. So let's not put all our eggs in that basket. Let's decentralize. Let's introduce more competition. Let's introduce more responsibility into the financial system. Let's rediscover sound banking. Thank you.
5 minutes of summation. Take it away, Frederick.
So we agree that actually that a lender of last resort does create moral hazard. And that by not having it, you might have less moral hazard, and as a result, banks would be more prudent. And that is something that actually is a problem for a lender of last resort operation. On the other hand, we know that there are shocks, and particularly because there's asymmetric information. If you think about what a panic is all about, is that there's a shock, one guy may or may not be in trouble, people can't see through their balance sheets, particular banks, they worry whether it's going to be whole or not. As a result, they have to take their money out. In fact, there's an externality that if they get there first, they get their money out first. In fact, this is why we call it a run on the bank. And then when one bank goes under, that contagion can spread to others. And so again, I recommend Friedman and Schwartz's discussion of what went on about the so-called contagion of fear and explaining how the first banking crisis in 1930 of the Great Depression actually led to the situation getting much worse. The way I think about this is that we can actually eliminate moral hazard. Let's think about driving. So you can drive and you can say, you know what, that if we put in seat belts, and you have to wear seat belts, and we put in airbags, you'll drive less safely because the probability of getting killed in an accident goes down a lot. In fact, the solution to the problem is let's put some knives into the steering wheel, and you're going to drive really safely then. I still would say that the likelihood of having bad outcomes would be much higher in that kind of situation. So I think that's the way I really think about this. And to summarize, I think the issue here really is about the overall economy's economic performance. And both in terms of the issue of shocks that are very big shocks, that are real shocks, nothing to do with the Fed or anything else, that they can propagate through the financial system, which is critical to the success of an economy. Making capital move from people who have excess capital to people with productive investment opportunities, that's why countries get rich. That's what capitalism is all about when you think about its being successful. But there are times when information flows stop. That's what a financial crisis basically is. And you no longer can get that to happen, then you're in deep trouble. And in fact, having a lender of last resort is absolutely critical. It's why the Fed was actually initially created. It's actually, the Bank of Canada was one of the latest to have a central bank. They didn't come until the 1930s. That's a key issue in terms of economic performance. And I would also argue, we could also get this whole debate about rules versus discretion, which I don't want to get into here, but it's related to this, that basically having this hard and fast peg to a commodity, let's say like gold or something else, is something that actually will produce more stability at the price level over very long horizons. But that's not what's really relevant to business decisions and household decisions. So Alan Greenspan had this wonderful definition of price stability. And it's very behavioral. And actually, it's a very similar definition to the Supreme Court's definition of pornography. So what was the Supreme Court's definition of pornography? You know it when you see it. And that's what Greenspan said about price stability. He said when you're doing your job properly with price stability, then in terms of your business and household decisions, you're not spending a lot of time worrying about what's going to happen to the future price level. And that produces an economy that's efficient, that works very well. And that's actually not a long-term thing. That's actually asking what's going to happen, when I go to the store 3 months from now, maybe a year from now, but certainly not, 10 years, 30 years, or whatever. That issue is not what's really relevant to households' decisions. So thinking about the Greenspan definition also tells you why I think that the gold standard period is not one that advocates for eliminating the Fed. In fact, the Fed, I think, will produce better economic performance both on the issues of making sure that shocks don't blow us up, and secondly, that we'll have a situation where, in fact, it's more predictable what prices are going to be in the short term, and that's what's relevant to people. Thank you very much.
So Jane, please open the voting. Yes, no, or undecided. Replacing the Federal Reserve with free market institutions would significantly improve the economy's money, banking, and financial systems. I have in my hand the Soho Forum Tootsie Roll, which will go to the winner of this voting. While you were voting, yep, that's the Tootsie Roll now, yes. While you were voting, just want to announce again that if you follow the crowds 2 blocks uptown to 55 Great Jones Street, you can be at the after party. And again, both Professor Mishkin and Professor White have consented to come to the after party. Most of us, a good half the audience, knows where to go, so just follow them, including Larry. He knows where to go in that case as well. I also want to announce that our new venture, which is the Soho Forum's Basket Society Salon, Sunday afternoon at 2 p.m. We will be discussing this debate, and Larry, who will be in town, Larry White will be in town, he will come and be in the hot seat about the debate. At 12:30, an hour and a half earlier, I'm going to show the debate on our large screen for those who didn't make it to the debate or want a refresher. And then Larry will show up for the Basket Society Salon again this Sunday. Our next debate will be on Tuesday, February 21st. Mises Institute Senior Fellow Ryan McMakin will defend the resolution, the breakup of the United States into different regions is a workable option, likely to bring a marked improvement in human affairs, which of course has complications for this evening's debate. And that will be against Libertarian Party Classical Liberal Caucus Chair Jonathan Casey. Again, that's Tuesday, February 21st, our next debate. On Thursday, March 30th, there will be a debate between senior Manhattan Institute senior fellow Jason Riley, who will defend the resolution, "Upward Mobility for Black Americans lies in rejecting the policies of progressive government while making the most of the opportunities offered by American society." Jason Riley will take the affirmative, and NYU professor Nikhil Singh will take the negative on that debate, and that will be Thursday, March 30th. Also, looking far ahead, we are taking our show on the road again, as we did for the last 2 years. On June 19th to the 25th, we will be taking the Soho Forum to the Porcupine Freedom Festival in Lancaster, New Hampshire. That's June 19th to 25th. On the Friday of that week, I will be debating David Friedman, the illustrious and widely published son of Milton Friedman. He will defend the resolution, "The right way to persuade people of libertarianism is by showing them that its outcomes are superior without any resort to the flawed non-aggression principle." Again, taking the negative on that will be me. And let's see, and how we're still coming, the vote is coming in? Yeah, all right. And then also, we have more to come, but I guess I'll announce that at some other point, because it looks as though the voting is coming in. Drum roll, please. No, thank you. Yeah. Okay, yes. Wow, oh, well, okay. Yeah. The yes votes for the resolution began at 41.9%, and the post vote for the resolution ended at 48.1%, picked up 6.2 percentage points. That's the number that beat. The no vote went from 25.8 to 32.5. Very, very close. It picked up 6.9 percentage points. You lost by a few tenths of a point, Larry. What? Yeah, you picked up a few tenths of a point more than Larry. It's a few tenths of a point. It's probably a statistical error, but you, what? But you still get the Tootsie Roll. Thank you to both debaters. 55 Great Jones Street for the after party. See you then.